Hello and welcome to a brand new show of Market Makers. My guest on the show today is Ravi Dharamshi, Chief Investment Officer with ValueQuest. As a firm, ValueQuest simply believes in one simple mantra. Price is what you pay, value is what you get. Ravi, what a delight to have you back on ET Now. Thank you for joining us.
Thank you, Nikunj. I'm delighted to be here as well.
What's going on? In the month of September, first we saw gut-wrenching volatility, then a majestic recovery. Have markets stabilized?
I think the volatility is going to continue for some more time. But the majestic recovery, as you put it, is definitely heartwarming. If you have hardly a partial rollback of the measures taken by the previous RBI governor, and market is ready to move above the level from where the correction actually started. So that tells you that, that there is a strong base somewhere in the market where a value investor is ready to come and pick up a stock that is going cheap.
Some would also argue that emerging markets have rallied against fundamental odds, and it's the flow of ETFs which have made all the difference. So Indian markets have appreciated, but there's nothing India specific about it. It's all about emerging markets which have got tactical inflows.
Surely, there is some amount of benefit that India is deriving from the loose liquidity policy of the developed world. And I believe that loose liquidity policy is likely to remain for some more time. So, can we say that we deserve to be higher? Probably you can intellectually argue that no, but I'm worried about generating returns, and I'm not going to complain. And as long as I don't see a scenario where overnight liquidity is going to be sucked out, I'm going to stay invested in this market.
But what is the good news in this market? GDP is contracting, earnings are not expanding, valuations are okay, and no capital formation is happening. And to top it up, inflation is also threatening to go up.
So, to put that question back to you, if I were to tell you that so many bad things are going to happen in next 3 years, rupee is going to go to 70, liquidity is going to be tight in domestic market, inflation is going to be stagnant, there is going to be stagflation in India, what would you have expected the market to be? Or what would you have expected a portfolio, what kind of return would a portfolio generate?
Negative return.
Well, since we were, our inception date is 1st October 2010, and we have generated 30% plus kind of positive return since then, till date. If that is the case, if market has thrown one negative out of the after the another, and if I can generate a 9% kind of CAGR in that kind of a scenario, I would expect in next 3 years, as more and more risks become known or get played out, the probability of the returns being higher in the next 3 years is higher than it being lower.
So what gives you the confidence that we have an economic bottom in place, and this is not the beginning of bad news flow?
It's definitely not the beginning of bad news flow. It's been, I mean, you just enumerated, and if it's out there in the media, then everybody is talking about it. The election issue is economy. So it's definitely not the beginning. How close we are to bottoming out, we can still debate. Somebody can say it's still 4 quarters away, somebody can say it's 8 quarters away. But it's a question of how much more, and it's a question of how much duration further before we start bottoming out. And market being market, they are the lead indicators. We are not going to wait for the actual economy to improve before we start saying, okay, now is the time I should go and buy. If I'm going to wait for that, then already the best part of the move might have been over by then.
Is it a right strategy to only look at the index, which is the Sensex on the Nifty, because it's only 15-20 stocks, at max 25 stocks which are holding on. So the markets or the benchmark indices are looking solid, but the cash market, the mid-cap market, the small cap market, that has got decimated.
I agree with you that it has been a very polarized market, but it is still, ours is a mid-cap portfolio. We don't have index benchmarking, I mean Nifty benchmarking per se. We benchmark ourselves to BSE 500, and we've still been able to generate a positive return. The number of stocks that have given fantastic returns is less, but I see more and more opportunities where I see things are, I mean, a lot of water has passed under the bridge and things are starting to improve a little bit. Maybe 1 more quarter, maybe 2 more quarters, and the company should start doing well. Even if RBI does not support growth, or even if government is going to focus on winning election rather than reviving the economy. So if that is the case, then I would rather focus on those stocks where I can generate positive returns. And I am sure there are lots of such stocks out there. Even if those 20-30 stocks that have had the maximum inflow, there might be some risk to that if the liquidity, global liquidity pulls out. But I believe in case these mid caps and small cap stocks are to get any further cheaper, then they are going to be going for absolutely throwaway prices.
So you are a buyer in this market?
Yes, I am a buyer in this market. I am trying to convince my clients to put in more money in the market. This is a good time. There are lots of value picks out there. First of all, the valuations were cheap. Second, there has been a change of management. Third, they are trying to reposition themselves from being a product and related services company to a IT services company. They are also being specialized in one or two verticals, or they're trying to get more focused and specialized. They have a healthy order book, and it's quoting at now it's quoting at a mid-teen multiple.
Within the mid-cap space, where are you treasure hunting? Because historically, mid-cap companies, they always suffer when economy is contracting. They're the first ones to fall, and they're the last ones to recover.
So we had at some point of, some time back, focused on mid-cap IT. We like agri as a space. Now you might say those are the exports and agri are the green shoots in the economy. So at this point of time, that is the case. That is where there is certainty of return. But I see lots of other bombed out sector as well, where the valuations have reached a bottom, and with some positive surprise on the earnings front, we can actually deliver fantastic returns. But for that, you have to extend your horizon to more than a year.
So let's talk about mid-cap IT. What do you like within mid-cap IT?
We like Mindtree. We like Tech Mahindra. We believe even in the large caps, there is a message going around that TCS at 4 lakh crore market cap and rest of the large cap put together is less than TCS. So
is that true?
Value. That is true. Wipro, Infosys, Tech Mahindra and HCL Tech combined are less market cap than TCS.
So the other way of looking at this debate is that TCS could come down.
TCS could come down. Or it could not be all probably. There is a tailwind to this sector. I am not going to bet on TCS coming down, but I believe that with the rupee depreciation, the cost arbitrage model has just got reinforced. With the US economy reviving, there is some tailwind to discretionary spend in the IT space. And these are not the companies that have any balance sheet issues or corporate governance issues. It's a question of growth. If the growth can revive, this 14-15 P multiple that most of the other companies are quoting at will start looking cheap.
What is that you like about Mindtree? The stock has seen a run-up of more than 50% in the last 1 year.
First of all, the valuations were cheap. Second, there has been a change of management. Third, they are trying to reposition themselves from being a product and related services company to a IT services company. They are also being specialized in one or two verticals, or they're trying to get more focused and specialized. They have a healthy order book, and it's quoting at now it's quoting at a mid-teen multiple. When we first entered the stock, it was quoting at maybe low double-digit multiple, 10 or 11 times. So I think with the tailwind of the IT sector and this company getting its act together, there's still further appreciation in this company.
Do you have a 3-year horizon for Mindtree? Do you think Mindtree could be part of your portfolio for next 3 years?
We sure wish and hope so. As long as the story remains intact, we are going to stay invested.
What is unique about Tech Mahindra? Again, a crowded trade, crowded stock, overowned stock.
If you put it in perspective, this is going to be in the top 5 IT companies with margins having bottomed out, and it is not part of any index. It is not part of any major portfolio. It is, I disagree with you over there that it is an overowned stock. It might have caught the fancy in recent times, but I don't think it's part of each and every portfolio out there. The sheer size and revival of margin and the tailwind to the IT sector makes Tech Mahindra that can generate decent positive returns even from here. And telecom, or rather BT, was something that was pulling them down. BT seems to have also slowed down in terms of falling. The ramp downs have slowed. Maybe it can actually stabilize over here, and the rest of the verticals can pick up. The rest of the non-BT business can pick up.
Private banks surely in last one quarter have lost their safe haven appeal. You own IndusInd Bank, you own ICICI Bank. Any regrets?
No, absolutely not. We have added further in these declines. Surely we did not expect RBI governor to come and tighten the yield at the short end, which is the main reason why these stocks are correcting the way they are. We do not believe that IndusInd, despite the worsening CV cycle, is going to face a significant deterioration in its asset quality. Some amount of valuation correction, some amount of the growth coming down cannot be ruled out. But we are quite confident from a 3+ year point of view. IndusInd Bank is the place to be from private banks point of view, and we prefer private banks over PSU banks because they are the ones those who have created wealth. PSU banks, they are the worst lenders. They are supposed to lend and they are linked to the economy. If economy revives, they'll do well. They do not have any USP of their own.
Why is your view bullish on ICICI Bank? I've read enough reports, and most of the reports are of the view that for ICICI Bank there are two problems. Number one, legacy issue. Number two, their exposure to infrastructure.
So both of them are interlinked. Infra and legacy are which is the reason why it is available at this valuation. It is a premier institution. It has been in correction mode, I would say, since 2009, when they said that they are not going to grow, they are going to correct their balance sheet. Their ROAs have suffered. They are trying to bring the money from their overseas subsidiaries back. The ROEs at this point of time are closer to 14%, and the NIMs, which were closer to 2%, have moved to 3% plus. So I believe over the next couple of years, ROEs should move to 18-20% kind of a range, and NIMs should strengthen further. It is now at the asset quality front, because you are the premier institution, you are bound to have some chunky accounts where there will be some problem. If, for example, JP Associates is the big problem area for ICICI Bank. But we have seen it. One cement plant gone, two more on the block. Maybe JP Power Ventures also sells out the hydro plant. The asset deleverage story has begun. It might take some time to pan out. It might be the second plant might take 12 months more. But the risk incrementally, as and when these leveraged players start deleveraging, the first person to benefit is going to be the lender, more than JP Associates themselves, because it is their risk quality that is improving. The ability of JP Associates to service its debts is going up. So similarly, I believe this deleveraging story is going to play out over the next 12 to 24 months, and that is going to benefit this legacy and infra problems that they have created for themselves. And historically, ICICI Bank has always quoted at 3x of book because of the problems, because of the recognition of the problems and the legacy issues. We are getting it at closer to 2 times book. I'm not even counting the valuation of the other subsidiaries, whether it is insurance or broking or securities, anything. Those values apart, you are getting a leading financial institution at 2x book, which has been in correction mode for the last 3-4 years. If they get it right, which we hope, the returns can be far higher. We have seen what has happened with Macau. It's 5x of Vegas, and it's hardly 10 years, 12 years old. So Asians, what is required and we can debate whether they can make it, they cannot make it, whether India can have a booming casino industry or no. But it is an option that I would like to have. If it does boom, I know that these are the guys that will definitely make it.
What is the core philosophy of your portfolio? Are you positioning your portfolio for domestic surprise or a global surprise?
Honestly, this adjustment we do only at the fringes. We can have some IT and some pharma if our view is that US economy is improving, or if the rupee has depreciated, they should benefit. We are not going to change the entire portfolio structure to suit that strategy. Essentially, our portfolio structuring is to generate absolute return from a 3 to 5 year point of view. And we have generated positive returns in stocks that are completely domestic economy dependent, whether it is Amar Raja or whether it is Sera Sanitary. We have generated positive returns even in these tough times. So entire portfolio is not going to be moved according to what the flavor of the season is, but some tinkering can be done at the fringes to accommodate. So to answer your question, I would definitely over the next 6 to 12 months want to reduce a little bit of the exports dependent to actually the domestic revival theme. How it pans out, we'll have to see. But that is the thing that I'm anticipating at this point of time. That sooner or later we'll have to do that. Get out of the export-oriented trade to more domestic revival trade.
Which is one stock which is currently part of your portfolio, but is also part of the high-risk, high-return club?
Delta Corporation is one such stock, which is very high risk and high return. And I would like to issue the disclaimer that we have vested interest in. But Delta Corp is a play on the gaming and the casino industry in India.
They've not delivered.
They have not delivered. The casino industry is very fledgling industry. It's in its infancy at this point of time, and it has lots of risk on the regulatory front, on the execution front. That is why it is the high risk, high reward. But if you look at it, the gambling industry, gambling is in India's blood. I mean, I can tell you, I mean, I don't have any figures, but there is a big cricket gambling industry out there. It's unofficial. So we have these card session every Shravan and
Diwali.
So yeah, so what I'm saying is that there is a latent demand out there, and these guys are leaders. They are the first to address it. Right now they are in Goa. They have gone from 1 ship to 2 ships, and maybe they'll have 1 more ship. And on the other geography front is their Daman, which might become operational in next 6 to 9 months. So they are expanding, and the initial response that we are seeing is very good.
Do you think Delta Corp could be a potential multi-bagger in 5 years if they get the strategy right?
Yeah, it is one stock where it can be 1-0. So
it's like buying an option.
Yeah, it is. If you get it wrong, you can actually lose your shirt. But if they get it right, which we hope, the returns can be far higher. I mean, we have seen what has happened with Macau. It's 5x of Vegas, and it's hardly 10 years, 12 years old. So Asians, what is required, and we can debate whether they can make it, they cannot make it, whether India can have a booming casino industry or no. But it is an option that I would like to have. If it does boom, I know that these are the guys that will definitely make it.
So what is your short-term market outlook, medium-term market outlook, and long-term market outlook?
So I would say from next 3 to 6 months point of view, the best case scenario that we can get is consolidation. We have done well to recoup the losses that had happened in the previous month. So some consolidation maybe, but medium-term and long-term outlook remains very bullish. I think we are closer to the economic bottom being formed. The last time around I had mentioned that the prices actually bottomed out in 2009. The sentiment bottomed out in sometime in 2011. And the economic news, the bad news, is going to bottom out definitely in 2013 or FY 2013, if not, FY 2014, if not calendar 2013.
And stock prices always bottom out much ahead of the fundamentals. So just to summarize our today's interaction, you are of the view that this is time to buy into stocks. This is not the time to get out of stocks, and individual stocks will still continue to surprise on the upside.
Absolutely.
And the key themes you're focusing on, number one is media, little bit of private banks, something in agri, and you're also bullish on an aggregate basis on consumption as a demand.
Yes, consumption is our underlying and overarching theme. When the various offshoots are, whether the private banks or the digitization, they are all part of it, and some amount of export exposure at this point of time. But that looks like it's a tactical. It might turn out to be a secular thing as well.
And you're keeping your fingers crossed and hoping that Delta Corp could be the next multi-bagger idea for you.
We'll discuss 5 years later. I don't think it's worth discussing in next 1-2 years. Whatever it might happen, it is a 5-year story. It's not a 1 year, 2 year story.
But banks can be a 2-year story.
Banks definitely can be a 2-year story. With the domestic revival, I think private banks are well poised and they can give good returns. Maybe some more volatility until the interest rates stabilize, until rupee stabilizes a little bit more. So, yeah, maybe 1 quarter out, the banks will be a great buy.
And some of the stocks you like, I'm just recapping the discussion: Mindtree, Tech Mahindra, Rallis, IndusInd Bank, and ICICI Bank.
Absolutely.
And the disclosure here is that you own them and you trade in them.
Absolutely. So, vested interest, please refrain from considering it as a advice to buy or sell.
Appreciate your time, and thank you for joining us on this edition of Market Makers.
Thank you so much, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.